Hey, what's up, guys? Hope you all are doing good. I'm doing well. In this video, I'm going to talk about how to create a balanced portfolio with leveraged and non-leveraged ETFs. Trust me, if you're a beginner, this will be an easy to understand video, and I'll walk you through step by step how anyone can create a balanced portfolio. Couple things that we'll talk more in detail about are learn how to construct a balanced investment portfolio by combining leverage ETF and non-leverage ETFs. Basically, what are leverage ETFs and non-leverage ETF? First, we'll discuss that, and then I'll show you how to construct a balanced portfolio. Lastly, I'll give you an idea of achieving optimal risk reward balance with this strategic approach that I'm adopting, and hopefully it will help me in future as well as it has already. So if you're ready to learn more about this, let's jump right into the video. So before discussing more on how you can construct a balanced portfolio, let's talk about leverage and non-leverage ETFs. So if you're watching this video, I assume that you know what ETFs are. ETFs stand for exchange traded funds, and these come in two types. One is leverage and second is non-leverage. So leveraged ETFs are the ones that are 2 or 3 times leveraged, meaning the effect of price going up or down $1 in each direction can affect their price $1 to $3 in either positive or negative range. So a good example of leverage ETF that I've talked earlier as well is SOXL, which is Daily Semiconductor Bull ETF. So how it works is if the stocks that this ETF holds go up $1, this ETF value goes up $3, and vice versa. If those stocks lose $1 for the day, this ETF will lose $3 for the day. And these are the effects that you see on leverage ETFs. So why do you need a leverage ETF when you already have non-leverage ETFs? The answer to that is fairly simple. You want to leverage your money. Basically, you want to take risk from the money that you have, in a sense that you don't want to lose all of that, but at the same time, you want to leverage your money to go up in the value if you see the market is trending upwards, and vice versa. So how do I leverage it? I'll show you a quick site of how you can beat the market easily with this lazy portfolio. So if you see here, this is the strategy that I started with. So I initially started with 33% investment in SPY or VOO. These are the S&P 500 index ETFs. Then I have another core position in form of SCHD. You can have DGRO or VYM alternatively. Again, I started with 33%. And my last 33% was invested in QQQ. You can alternatively have SCHG and QQQM. But the introduction of cash to my portfolio to sell cash secured puts and covered calls divided this portfolio into 25% each. And this portfolio has proven in last 15 to 20 years to beat the market. So how can you build this portfolio? Say, for example, if you are starting off with $1,000, you can divide that in 4 equal proportions and see if that fits your way. So that would be $250 in SPY, $250 in SCHD, $250 in QQQ, and $250 in cash. Once your portfolio grows to a value substantial, something like I have here, then you can start selling cash secured puts and covered calls. If you don't know about cash secured puts and covered calls, I have a detailed video that I'll link in the description box that you can watch to understand the basics of cash secured puts and covered calls and how you can get started with them. But this portfolio is the lazy way of beating the index. And what I'm teaching you, I can show you actually my current portfolio has the similar kind of division. So if you see here, QQQ or Qs as they call it, I have 33%, close to 33% investment of portfolio. Then SPY, I'm investing more in it to get to 100 shares. That will be the end of investment in SPY from me for at least foreseeable future. So that'll take it again to 33%. And the last one, SCHD, which currently is at 26%, but initially I invested the same amount, 33% in this, since SCHD has not grown in last 3 years substantially. That's why the portfolio diversity has dropped to 26.32%. But overall, if you talk about the overall investment, I am targeting all of these three core positions that I have to hold 25%. Then the rest 25%, I'm selling cash secured puts. So if you see here, I'm selling a cash secured put on SOXL at $24.50. So if you do the math, $24.50 times 800 equals to $19,600 that I have tied up of my money. If you see here, I'm selling 8 contracts. So this is the amount of money that I have tied up with SOXL for a week's time. Once this is over, the money hopefully will be sent back to me and I will again sell a cash secured put and generate some passive income with that. So this is it. Thank you guys for watching. I hope you guys really liked this video. I really had a lot of fun researching about it and coming to the conclusion of a portfolio that can actually beat the market. So that's about it. I hope I'll see you guys in my next video. Till then, take care of yourself and people around you. Goodbye.